What's up, guys? Welcome back to Zodiac Trading. As I have previously concluded in our YouTube channel, we mainly discuss a lot of macro trades, option tradings, and different multi-cross assets class kind of trading. So, in this channel, you are not only going to find many resourceful opinions as well, you can find a variety of different trading strategies, especially it's not only like equity trading strategies. Sometimes I cover option trading strategies as well. So right now I've been giving a lot of consulting services to a lot of family offices and also financial institutions. So I think what I'm going to offer here in this YouTube channel might be interest you. So here, we're having another Fed meeting, and now we're seeing that Fed delivers another hold. And I think um, this could be a very important signal when we're trading from, when we're trading the next uh, to the end of this year. This will be very, very important signal and might be important for next year as well. So this time, Fed decided to keep the fund rates at 5.25 to 5.5% for the second time, but also claimed that it's going to keep the door open for another hike because of to slow down the inflation pressures. Because right now the U.S. inflation is somewhere around 3.7%, and is still high compared to the previous low, 3%. So I think the Fed still has to maintain its stance. But it doesn't mean that the Fed will decrease the interest rate or say to end this restrictive policy regime any sooner. So I think it's very important for me to address this information in the first place. So the reason why the Fed is expressing such signal and also attitude is because of the market condition, and we are seeing uh, the dollar right now strengthening very much, and the dollar index DXY is trading very strong, and so we're seeing that dollar reaching around 107, which is the recent high, and that recent high actually brings the downward pressure for the macro economy, and it's going to heat. It's going to bring setback to the U.S. economy, and I think dollar right now, the very strong dollar is becoming the obstacles for the economy to recover. So I think right now, because of the dollar and also because of the yield, we're saying that the bond yield, because we all know the bond market hasn't been really quite well recently because of the mainly because of the inflation. Inflation is bad for the bonds. So imagine in inflation economic scenario, you're holding bonds. That actually means disastrous because you're not going to have the same compensation. You're probably not going to make enough to compensate that inflation. So it's kind of bad for the bonds. So also it hurts the bond liquidity as well. A lot of people were long bonds and they are expecting the rate to be lower, but then they've been proven wrong for some time because of if you actually see from the 2-year and also 10-year bond yields, you see what's happening here. Okay, because obviously the 2-year, the dollar, and also the bond we are seeing here, the 10-year bond note yield was trading at almost 5%. And now I believe this bond yield could be recovered, and the bond yield will be lower quite quickly, and it's going to be back a lot lower right now. But I think that's only for temporary because we don't know if that inflation is going to come back or not. If inflation come back because of these Israel Israeli to against the Hamas war become something pain in the ass. That is going to bring input inflation, and that's going to bring the oil price higher, potentially damaging the bond market in the future. But right now, we'll focus on longing bonds, also shorting the treasury bond yield. Also, that's probably the same for the 2-year treasury note as well. If we actually see the 2-year treasury bond yield right now is trading at decade high. Okay, so it used to be around 5.22, and now it's trading below 5. And as you can see, it is a strong trend right here. And we are going to see that bond market correct itself. So because of the bonds market, because of the dollar, the strengthening dollar, and also because of the rising inflation, the Fed, which is the reason why Fed hasn't been a low interest rate any sooner. But for a lot of institutions, financial institutions especially, they've been holding that kind of strong belief that the Fed is going to lower interest rate because uh, in such economic phase, not just say back to 1970s, the hyperinflation and also plus the high interest rate environment is bad for the business, especially for the finance business. It's good for a lot of energy resources, a lot of cash income kind of industry, but it's pretty bad for finance, banking, and etc. Because that basically means high interest rate could mean that you're going to pay more when you're going to pay mortgages. So interest rate goes higher, you end up paying more to the banks. And also banks, on the other side, the financial institutions, they have higher cost, higher operating cost, and at the same time, you don't have much. You don't really, as a banker, as a financial institutions, unlike the economic condition in a QE scenario, you don't really have much to invest. That's the problem. So when you look around, you have to pay your depositors quite amount of compensation. You have to pay them interest rate for them to keep the money in the bank. So that could be your liability. And at the same time, you couldn't find any attractive investments to invest. So that would be for the bank, that would be really troublesome. Which is the reason why I understand why most important bankers and most important financial institutions, and also along with investment banks, been saying that like interest rates going to be lower, been lower. They've been saying this entire year, but the interest rate hasn't been lower. That's the case. And I think to this point, the Fed, okay, from this meeting, yesterday's meeting was plain and clear. Okay, it's dovish, and people expecting nothing less and nothing more. It's just another hold, right? But the people start feeling that the Fed is acting, the Fed is kind of easing in some sense because the Fed is not adding kind of information to the speech. But that does prove the Fed has been losing control of the status quo, because the Fed in sometimes should be ahead of the curve. The Fed as bureaucrats, if you're the Fed officer, if you're Jeremy Powell, you should be ahead of her. That means you should be leading the market. You should be giving the market what to expect, not the other way around. So right now, the Fed has been really obsessively, data driven to I think to a sick extent, because what the Fed's been doing is just to weigh the data, interpret the data, and they try to use that data for everything that they do. So they don't really have their own opinion. They just react to the data. But the economic data itself could be that doesn't really show the full picture of the economic right now. I just take one example, right? So a lot of people hold a lot of people are paying mortgages. They are paying for student loans, and what they can do is because they had these kind of mortgages a couple years ago, back in when the interest rate were low, so they are paying very low interest rate. And then something happened, if that mortgage is floating, they could just refinancing their mortgages. And now because the banks are expecting the interest rate could be lower, so that means the bank, if even if the bank's gonna give them refinancing, they're not going to give a higher interest rate. They're not going to give a very expensive interest rate for them to pay off. They're probably gonna have somewhat more a slightly more expensive but affordable kind of refinancing package for these mortgage payers. So, and also for the student loans, that happens as well. But once the financial institutions and banks discover that the Fed is not going to lower interest rate any sooner, what would they do? They're probably not going to. They're going to stop refinancing. They're going to higher make the mortgages more expensive or affordable in the future. So you're not going to, as a mortgage payer, you're probably not going to get a cheap refinancing. That's the case. So the Fed, how is the Fed going to react to that reality? Because right now the interest rate hasn't really hurt the actual economy yet. People like these big giant companies and these individuals are just depending on low interest rate financing. And actually, we're actually seeing mortgage rate dropping to new low, and that's the case, right? So the Fed hasn't seen the real data. The Fed failed to see what really happens inside. There's a ticking interest rate time bomb in the financial market, right? If you lower the interest rate, the inflation might come back, and inflation may be higher. And the next time, if you want to tame that inflation back down, back to 2%, you end up raising the rates even higher, and that end up hurting economics even worse. So what the Fed should be doing now is to become ahead of the curve instead of massively data driven. So that is what my take on the recent Fed deliver and the recent Fed meeting about these rate hiking. So every time I would try to make a commentary video about the Fed decision. So I've been, as a macro trader, I trade bonds and trade interest rate products. I trade FX products. So I try to share my opinions and my views to most of the international communities, because we have many traders in our platform. You're trading different products, and I'm like trying to share all these important messages to the traders around the world. So if you like the content, please subscribe, share, and press the like button for me. Uh, Please join me if you have anything to say. Join me in the comment section below, and I will see you in the next episode. Goodbye.